Okay, folks, here we are again. This is the ZOOPLA UK House Price Index up to August 2022. All the information that Zoopla has collated in terms of house prices of their website rolled into an overall picture of where we are in terms of the UK market. Some interesting headline statistics here. Some of them, before we go into the detail, is the housing market is transitioning to a buyer's market as higher mortgage rates are set to cut buying power by up to 28%. The jump in house prices over the pandemic is compounding the affordability challenge, especially in the southern England. Now, the affordability challenge is the multiplier of the average wage compared to the average house price. In Scotland itself, the multiplier stands at 6.22 times. In Fife, it actually stands at 5.43 times. In other words, you've got to have 5.43 times the average salary in Fife in order to afford an average house in Fife as well. The UK itself, though, this is a startling 9.42 times. The price in the UK, the average price in the UK overall, right through the whole of the UK, is 15.5% increase year on year. In Fife itself is 8.8%. In Scotland, it's 9.9% year on year. So it just shows you that England and the London market and that team seem to be running away themselves in terms of the house prices. It's almost fanatical still in terms of their house price rises. However, they have said, though, that the transitioning of the buyer's market because of higher mortgage rates will take place, cutting buying power by up to 28%. If you've got any questions, please feel free to ask. Some regions have seen 10 years of house price growth compressed into 2 years. To be honest, I think that's what's really happened in Fife over the last 2 or 3 years. You've got 10 years of house price growth, which has never really happened as such, and it's actually just been compressed into these 2 or 3 years that have just happened, which is effectively round about in the last 3 years in the house price growth in Fife, round about 30% in house price growth. That's a big number. So it's all come at once, hence the reason why it's cause and effect. We're getting this huge impact, and then we're also getting a huge fallout as well. So it always happens. It's quite typical. It's nice to have a normalized market, which actually just increases probably every year by 2 or 3%, but that's about it. In line with inflation, in line with the salary rises and everything like that, and keeps everything nice and stable. We don't like big, huge swings, like huge inflation spikes and all the rest of it, but we'll talk about that, and huge mortgage rate hikes as well. But we'll talk about that throughout the report itself. The other headlines as well is new sales are holding up with no sudden drop in demand in recent weeks, but buyer interest is weaker than a year ago, according to ZOOPLA statistics. Now, I could actually corroborate that as well. Yeah, absolutely. The housing transactions, the number of sales is actually holding up still. So the number of transactions for houses being sold or being bought is actually holding up. The number of transactions for the houses being sold is actually, there's more properties coming onto market than typically in the last 6 months. So it shows you there's a wee bit oversupply coming on, and that would just continue to go. Kind of leveling off overall, to be honest, of where we are before. So I don't think it's really anything substantially to panic about, although the news would tell you a different story. Everything on the news seems to be doom and gloom, and after all, it's this news. Anyway, let's talk about other headlines. Asking price reductions at the highest level since before the pandemic as sellers adjust to a more price-sensitive demand. Now, that's throughout England because England don't have home reports. There's no set value in the beginning, so you tend to find estate agents are going for a higher value overall, over and above the home report, and it tends to be leveling off and coming down as well. So asking prices are getting reduced in the English market. In terms of the Scottish market, because we've got home reports, we tend to find that asking prices are coming in round about the home report value or just over the home report value this time. Right now, whereas opposed maybe a year ago, they were going about 10 and 15% over the home report value. It's becoming a more leveling off exercise. So if you get an offer around about the home report value or just over, yeah, it's a pretty good offer at this point in time, I would say. Unless your house is exceptional, then that's the only reason why you would think I'll hold out for more. But that would be based on the fact that you'd probably have a lot more demand, or you're just onto the market at this point in time. So that's key things to remember when you go onto the market for the first time. Yep, you might get an offer straight away, but you've got to then compare that offer and say to yourself, is there any other activity at this point in time which make me suggest that to think that waiting would be a great idea for a better price? Other than that, if there's not any compelling evidence to show that, you should seriously consider that offer right now. Remember, it takes 2 or 3 months to actually get this over the line. So things can actually change in that 2 or 3 months' time as well. So that's probably important to bear in mind if you're currently on the market, currently going onto the market in terms of selling your house. Stamp duty changes in England will support regional markets and the first-time buyers in the southern England at the low cost to the exchequer. So, you know, they've not done anything in Scotland. I wish they had, to be honest. Maybe they're holding out a wee bit to see if that's something they want to do later on. Maybe they don't just want to follow suit. It might just be a I don't want to follow you thing. Hopefully it's not as petty as that, but you never know. So let's look at the numbers overall in a graph form. Here it is right here. So this is what we talked about, the demand, and we can see in the black area, it's September last year compared to September this year in terms of ZOOPLA's demand. So they've had a demand was 23% last year, whereas dropped down to 8% over. So it's leveling off. So I mean, if it goes to zero demand, it means it's like for like. It's a 50-50 market in terms of sellers and buyers. Number of sales agreed, there's less sales agreed this year at the same time this year than there is last year, but still over the average. And then you've also got a flow of new supply. There's as I said, there's that 4% more supply coming onto the market than there is. Last year, there was 11% less supply coming onto the market than what was being sold as well in terms of the new stock levels. Okay, so stock of homes for sale still may remain traditionally low in terms of what it was previously. So stock of homes for sale over the 5-year average was 31% last year, less than the 5-year average. This year, the stock of homes for sale is minus 21% less than number of homes for average. This actually tells us still that there's an undersupply in the market. But at this point in time, if you understand what I'm about to say here, there's a quick rush of oversupply coming on at once, all at the same time. It's like the floodgates opened and then all of a sudden it could be closed in 2 weeks' time in terms of the number of properties coming on, and it could level off again right back to where it was. That's kind of how the housing market is right now at this point in time. Like, there's a wee bit, you know, let's release some pressure, bring a lot more properties onto the market. So that's that graph. Okay, so as I said, headline statistics. Let's go in and delve a bit deeper into this fast evolving micro market. Okay, so the fast evolving microeconomic backdrop. So the macroeconomic backdrop. Put my teeth back in. So microeconomic is a detailed level in terms of economics. Macro is a overall pictured level. So it's a higher, in terms of higher level macroeconomic. The macro backdrop of the housing market has evolved rapidly over the summer. Central banks have increased interest rates to bring down inflation. There's no doubt about that as well. And they're talking about that as well in terms of propping up the economy because of the recent mini budget, because it's not gone down well with the rest of the world. In terms of keeping our pound at the right levels in terms of exchange. Just to explain to you, in terms of the pound, where they say the pound's dropping against the dollar, it means really that because the dollar is now almost at a point of £1 equals $1, it's more expensive to buy goods from the UK, from the United States into Britain now in comparison to what it was 2 or 3 months ago when it was $1.3 to the pound. In other words, your pound was buying more goods and services from the US in order to import into this country. And the reason they would do that is maybe because of raw material supplies. Maybe they actually come from America. There was a gentleman on this morning about his business. He buys these bikes in and assembles them in the UK, but he buys them in from America, and his costs have gone up 5% because he has to pay in dollars. So therefore, he has to exchange pounds to dollars, gets less dollars, then he has to pay them more dollars than he would have paid before. Hopefully that makes sense to anybody out there. It doesn't really understand what exchange rate and how important it is. It does, though, make our exports very attractive to the rest of the world, especially America, and I would say especially Europe as well, because the euro is actually at 1.1, where it was at 1.3 2 or two or 3 months ago in terms of exchange rate. So again, it's a similar situation. Imports become dearer, exports become cheaper. So we should see big export markets in terms of what we're doing. So we're supplying raw materials or anything else to someone else outside of the UK. It makes our products cheaper. Potentially, we could put the price up a bit more, because then they'll be able to we'll be able to get a higher margin on that. But that's a difficult situation because I was involved in manufacturing before as an accountant. And it's often that the supplier abroad or the customer abroad immediately says, well, we should be reducing the prices because he's getting a better exchange rate and he could buy more at a similar price. But when it comes to change round again, you tend to find that they don't want to increase the price again to themselves. Interestingly, they don't want to see. They want to see the good side. It benefits them, but they don't want to see the bad side. It benefits us, if that makes sense. So let's carry on with the housing market. Despite the challenging backdrop, these factors have not yet had a material impact on the leading indicators of sales market activity in terms of the housing market. A strong start to the year has carried the momentum into the summer. As we enter autumn selling season, demand for housing continues to soften and is much lower than this time in the UK last year. The UK-wide demand remains 8% above the 5-year average, which is showing on that graph before. We'll take a quick look at that. You can see there the 8% there, in that wee graph there, that 8% above the 5-year UK average, supported by strong buyer interest in affordable markets such as Scotland. So Scotland is an extremely affordable market. That's what I said to you before. It only takes 6.6 times almost the average salary to buy a house in Scotland, whereas in England it takes 9.5 to 10 times the average salary. So it makes it more affordable buying Scotland. And in Fife, it makes it even more affordable. As I said, it takes about 5.5 times the salary, average salary in Fife to buy a property in the Fife area. So it's actually really good from that point of view. Okay, the UK government has responded with tax cuts and energy price caps to support the housing demand. Changes to stamp duty will boost some segments, and the recent spikes in borrowing costs are set to push mortgage rates higher. Rising mortgage rates are set to impact on buying power. So let's have a look at that graph here. Here's the rise in mortgage rates in terms of this, and let me just explain what this all means. So most new loans are at fixed rates, and the cost of securing finance for these mortgages does not directly follow base rates. These costs have surged recently, and mortgage rates are on track to reach an 5% by Q4, more than double the rates at the start of 2022. So you can see here where that impacts. Our analysis, in other words, ZOOPLA's analysis, shows that if mortgage rates rise from 2% to 5%, buying power will reduce by as much as 28%. So it's assuming that the buyer uses a 75% loan to value buy as an average price home, which would cost around £825 per calendar month, and the mortgage repayments at 2%. Keeping repayments the same and moving to 5% rates means that the buyer can afford a mortgage that is 28% smaller. Okay, so hopefully that's made sense. So you can see there how that loses up, how much the average mortgage can be afforded on the monthly repayment of £825 per calendar month. As the mortgage rates rise, you can see that right there. And as mortgage rates rise, you can see how it comes down in terms of demand and what they can afford. So it comes from 193 at the 2% rate, and as mortgage rates go up, they can only afford 139,700 with the same amount of money. So you can see if you can only afford £825 a month for a mortgage repayment, then as interest rates go up, then your buying power reduces from 2% to 5%. It goes down to 139,700 from 193,500. Hopefully that's given people an idea about how mortgage rates going up actually impact the buying power in the market. So it does mean though that lower value properties actually will be more favourable for people as mortgage rates rise. So if you've got a lower market value property, actually might make it more attractive for somebody to buy that. So you might actually get more demand, whereas people with higher value properties might actually get a lot less demand. Okay, so that's their analysis. Now this will impact housing demand into 2023, they say, for the 7 in 10 buyers using a mortgage, unless they put down larger deposits or allocate more income to mortgage costs, or adjust their budgets, buying smaller properties. As I said, they've just said that they're looking for cheaper areas. I would say less expensive areas. I don't like the word cheap. It implies there's something wrong. I would say it's more less expensive areas. And the fourth option is to sit on the sidelines until the outlook for the borrowing costs become a lot clearer. That's what they're saying, sit on the sidelines. Well, I'm not really sure about sitting on the sidelines, because if you're sitting on the sidelines and you're in a rented property just now, the trade-off in the fact that you're going to be in rent and you're going to be renting for all that time, waiting for a price adjustment, the amount of money you're spending on rent and losing on rent, and with a price adjustment, even if it dropped 10%, actually over a 2-year period, or even a 1-year period, might actually be a lot more you're paying in rent than you actually are, even if the price drops after you buying it right now. Hopefully you understand that and understand these numbers, what I mean by that. You know, if you work out how much more rent you're paying, having to wait on the sidelines to see if there is going to be a price drop, compared to the actual price drop that might happen. If there is a price drop of 10%, all we're doing is going back to a year ago, because prices in the last year have moved up 8.8 to about 9%. So if you're dropping 10% in the housing market, you're only moving back to where it was a year ago. So there's no this catastrophic drop like the credit crunch gave way to, which was dropped by 20% overnight, and therefore everybody ran for the hills, panicked. There was a run on the banks. There was debt swap equity swaps that were actually being done in the background, and bets and sub bets and other bets on things changing, the market changing. That's what really wiped out the banks and the liquidity. It wasn't anything to do with what's happening in the housing market. It was all to do with subprime mortgages and actually how they were being sold. Subprime mortgages actually don't really exist that much in terms of what we're doing now, because people are actually qualified in terms of their affordability, and they have been up to since 2014, up to just maybe about 2 or 3 months ago, when the affordability checks were actually taken away. They're obviously stress tested as well, a lot of the mortgages, so affordability should still be there regardless. The higher rates continue to creep up. What you've noticed in the mortgage market, though, the mortgage market has recently withdrawn probably around about just under 300 different products. Most of them are fixed rate mortgages, so you can only really get discounted rate mortgages or tracker mortgages at this point in time, which is all right. So there's still about 75% of the mortgage still available that there was in the market before, which means there's probably about 900 mortgages products available right through the market. So there's not an issue with liquidity. There's not an issue with getting a mortgage. It's just that you'll not really probably get fixed rates, because the banks don't want to do that anymore, because there's a wee bit of uncertainty in terms of their market, in terms of what they could do, in terms of where their borrowing is as well. And because at the end of the day, the banks have to borrow the money, or they have to take the money from a saver and then lend it out to you at a higher rate in order to make a return. But if interest rates are going to go up, and they predict it going up, then the savers' rates will have to go up as well. So if they then fix a rate with you, they are then going to leave themselves out of pocket dramatically if there's a wee bit of uncertainty into where base rates are going and how they're going to raise up. Because the Bank of England then is the people that actually confirm that to be the case. So the Bank of England confirms the base rate increase, then the mortgage companies then have to take into account the fact that that rate's gone up. But the Bank of England says that these rates have gone up, therefore it'll probably impacts on savings rates as well, because then people get higher savings rates. So they then have to put up the savings rates for a person that's saving money right now. Maybe put it at 2%. It's maybe going up to 3%. Therefore, they'll have to charge a higher mortgage rate. So if they have fixed their mortgage with you and borrowed that money out and lent that money out that they got from you, the saver, to a buyer as a mortgage, then it's difficult for them to fix that rate, because, as I said, they will be left out of pocket. Hopefully that's clarified it a lot more. If you need more information, please feel free to just double check and ask us a bit more questions. Pandemic boost to prices adds to affordability pressures. Let me have a wee look at this and let you see this graph here. This is actually quite an interesting one. So that's that one, and here's this one. This is flats and houses. The impact of higher mortgage rates on market activity will be compounded by sizable increases in house prices over the pandemic, which has been done. The search for space and record low mortgage rates have resulted in the average value of the house increasing 5 times more than the average value of a flat over the pandemic. You can see that. Look at the flats. and how they've gone up. And they compared to the houses have gone up hugely in every area. Look at Scotland. So here's Scotland here. Flats have gone up round about on average. They're saying round about 9%. Houses have gone up 21% in comparison in terms of the same period. So it makes a fundamental difference. That's why I still believe, though, that flats will still be more affordable and people will go for flats because they're less of a value and they're more flexible in terms of the accommodation. Okay, so the search for space has actually seen that. The graph below can show you there the house. The average value of a house increases 5 times more than the average value of a flat over the pandemic in this chart. While London has lagged behind the rest of the market in terms of annual growth rates, the average house value in London has increased by over £100,000. The average price in London now, I think, is around about £505,000 for a property. Think about that. Fife is 168,000. Scotland's 192. And the UK on average is 292, but London's 505,000, over $500,000 to buy an average house in London. That's crazy. How could that be affordable? How could that be sustained? But the average value of a flat in the capital has increased by 2.4%. The weakest national segment in percentage growth terms as buyers prioritise space and working from home. The capital actually as well, in terms of the capital is in London, has actually seen a huge influx of flats actually being built. So that could be a lot to do with it as well. That then stabilises the prices because there's an abundance of flats on the market at one time when they're all getting built. Nobody wants to build houses in London anymore. They want to build flats because obviously that's where the money is in terms of profit growth and margin. But it isn't for a person buying at that point in time because there's an oversupply of flats in the market. So therefore, buyers have a lot to choose from. Just like when they build abroad in Spain and stuff like that, you know, there's a huge amount coming to the market. It's a long time before you can resell any real significant value because there's more and more new properties coming on similar type at the same values. So the pandemic impact over 10 years of house price growth. Let me just briefly talk about that. Houses in Wales have recorded a 27% jump in prices since the start of the pandemic. This is equivalent to 10 years of pre-pandemic growth compressed into just over 2 years. A similar pattern has been seen in the north, east and also in Scotland, largely due to the below average price growth since 2009, as I've said before. Across the other areas and the property types, recent price growth has been the equivalent of 4 to 5 years, highlighting how much prices have jumped ahead. So the greatest hit to buying power in high price and high growth markets is, well, this is really the momentum and price rises has supported measures of market activity in the first half of 2022. There are no major signs of a major slowdown in price inflation. The average UK house price has increased by 8.2% or over £19,650 in the past 12 months, although the quarterly growth rate is slowing overall. Looking ahead, higher mortgage rates will have the greatest impact on activity in higher value markets and areas which have registered the greatest surge in prices over the pandemic. Okay, so let me go on to then talk about what's going to happen next out of that then. Asking price reductions rise to pre-pandemic levels. So this is a key one here. This is the next indicator. The asking price reductions are rise to pre-pandemic levels. So we're starting to see early signs right across the UK of price sensitivity from the scale of reductions in asking prices for homes for sales. This is what I basically mentioned in the beginning. Sellers want to maximise the value of homes, and when house prices are rising quickly, and agents need to anticipate the strength of demand and the price ahead of the market is needed. However, when demand starts to shift, agents and owners need to adjust it as well. So just because even in Scotland, when we've got home reports, just because you were getting 10 and 15% last year, you don't expect 10 and 15% this year. If you're getting an offer, seriously consider it, because it's not going to happen now, because all these 10 and 15% from last year have actually been factored into the prices this year when the home report's been set. That uplift has already been put in, so you've got that uplift already. So that's the key here. There's also been a clear upward trend in the proportion of listings which have also had asking prices reduced by 5% or more over the spring and the summer. The latest data shows that 6% of homes listed for sale have seen asking prices adjusted downwards. This is the highest level since before the pandemic, although repricing is a common seasonal trend. So repricing is a common seasonal trend as we are entering an autumn market. Given the economic backdrop, ZOOPLA actually sees this as a move to more of a buyer's market after 2 years of a red hot seller's market. Right now, we don't see any big variations in price adjustments by region or property type. The adjustments are expected to be as the market transitions from one where a demand greatly exceeded supply to obviously the other way around. There are not precursors for big price falls, but indicate that the rate of price growth will slow more rapidly in Q4 and into 2023. Let me just show you this. Just pop onto the next one here, and that'll show you exactly what's happening here in graph form. So you can see it there. There's the asking prices being adjusted for more price sensitive buyers. You can see that asking price reductions at the highest level since Q3 in 2019. There you go, see that dotted line right across there. And now you're beginning to see asking prices a lot less. So it's actually coming down into the quarters 2020, 2021 and 2022. So price reductions are getting adjusted. So it did start to get adjusted before. The pandemic, obviously, asking prices were never adjusted. They went right down to minimal in terms of the value all that time, and now it's coming back up into line where asking prices have been more price sensitive, and they're being adjusted at a bigger value, which is over here. This is the percentage of your sale listings with price reductions. So you can see that that's the percentage of sale listings with price reductions is actually beginning to increase again. So pandemic came in, nobody was doing price reductions, then all of a sudden it's now starting to come up again. So what does this mean? Any homeowner wanting to sell their home in Q4 or early 2023 will need to price at the right level to ensure their sale. Sellers need to shift their mindsets. You need to shift your mindset, giving more consideration to local market dynamics and the types of buyers for similar size properties in the local area. In other words, if you see a property similar to yours, or maybe at the similar size in your area, look at that price point and compare it. If your price point is actually more than that, then you might have to readjust your price. If your price point is actually less than that, then you might be expecting a wee bit more than what that is. If your pricing is bang on, then you're effectively competing against that property for their attention. That comes down to a really good agent who has good video content, who has good description content, who has fantastic photographs, and has good local knowledge as well. So when they contact and the buyer, they engage with the buyer then knows what they're actually buying into in that area. Buyers buy into emotion. They buy in what it can be for them, not what it is for them. It's features and benefits. Nobody buys for features. Everybody buys for benefits. You don't buy a lawnmower for to mow your lawn. You think you do, but you don't really. You buy the lawnmower to mow your lawn, mow your lawn. But after you've mowed your lawn, then you can spread your picnic blanket out and you can have a picnic with your family. That is the benefit of mowing the lawn. The feature is you can mow the lawn with a lawnmower. You don't buy features, you buy benefits. It's the end result you're after. What does it mean to you and your family? That's why buyers buy property. Whilst the rising borrow costs will see demand weaken in the coming weeks, we expect the ongoing pandemic impacts and the cost of living pressures to continue to stimulate homeowners to want to move still. Those who are relying on taking a large mortgage will be most impacted by rising borrowing costs, which is most likely to impact buyers probably in southern England because they're a lot higher in terms of prices. The change to stamp duty will support demand in the lower value areas as well. Stamp duty changes deliver some specific benefits for England. We'll maybe briefly cover that. I'll show you how that will happen, because it really doesn't have a major impact in Scotland. Let's show you that graph and I'll quickly. Stamp duty reform improves choice for first-time buyers. Here's what's happening so far in terms of the market, in terms of the England market, first-time buyers versus homeowners. You can see the difference in levels of the relief that you're getting. And basically the stamp duty is to encourage first-time buyers in the English market. Remember, the stamp duty changes have been done in the English market, and not the Scottish market. But it's basically to encourage, because they've got so high price points in terms of their average price point compared to Scotland and compared to Fife. They're sitting at almost 300,000 for the average price of a house. We're sitting at almost 200 in Scotland, and in Fife itself we're sitting at about 170,000. So you can see why they would want to stimulate that by increasing the stamp duty thresholds to encourage first-time buyers, so they don't have to pay this tax burden on buying their first property. They want to encourage them to buy their first property, because that'll keep a nice solid flow of the actual housing market itself in England in particular. So Southern England continues with high stamp duty costs, and that's why they're having to make these changes. Let's just finalise and finish off here. We'll just look at the country house price index by country, in region and city. You can see that across there where everything's moved up. Now there's Aberdeen down there again. You can see that minus 0.9%. I think that's basically because ZOOPLA's not got enough data to actually use that. Aberdeen is consistently moving up in price. It is actually quite a good market, maybe 3 and 4% positive all the time. So it's going the right way. So I think that's just because they've not got enough information overall, but they do have good information around England, also around Fife and around Scotland itself. So you can see there Scotland overall, according to ZOOPLA, 5.7. And then overall, when you look at Northern Ireland, you've got 8.9. You look right across the different regions, London 4.2. So everything seems to be going the right way, in the right direction in terms of the housing market by country and by region. Finally, we'll just look at in terms of prices. And so that's growth, and that's let's jump onto prices. Just zoom in on there. And it's because you're right across the board, the big hitters there. Big hitters there are clearly Nottingham, Leeds, and percentage have moved up over the years, year on year. Manchester, so southern, sort of middle England, southern England, that sort of area. You can see it comes down to the bottom, and where the Glasgow market's 4.8% in terms of price increase. London, look at London, it's 524,000 average price point now. That's crazy. Who can afford that? 4.2% increase in price. Edinburgh's 260. I mean, look at this. Edinburgh, the average price in Edinburgh is 263,000. The average price in London is double that. And I'll be honest, I'd rather live in Edinburgh. To put it in a nutshell, I've got to say, Scotland, if you're in Scotland, welcome to God's country. If you're outside of Scotland, unfortunately, you're not in God's country. And that's it, guys. Hopefully that's given you a good insight into the UK property market as well as the Scottish market and the Fife market overall, and explain to you about supply and demand and how it's moving from a seller's market overall, red hot seller's market, to now leveling off into a seller and buyer's market, almost a 50-50 price point now. So there's still decent demand overall. There's the same demand as probably last year, but just a bit oversupply. It's causing this to level off. Interest rates rising will be that inflation, and you've got utilities and costs rising as well, which will impact on that, probably at the higher price point areas. So if you do have a higher price point property, you really need to seriously consider at this point, if you've got an offer on it, possibly seriously consider accepting that, because it could, the way this is going, it could probably just get more and more challenging as your market begins to narrow with the amount of buyers that you have available for that type of property. Okay, that's me. Thank you very much for your time. Thank you very much for holding on here, and until tomorrow, it's bye-bye from me.